of stochastics. One of the most respected, well-known trading indicators in the marketplace. Trading stochastics helps us see if a market is overbought or oversold. Now, even ever had an apple fall on your head while sitting under a tree? No. Well, me either, but Sir Isaac Newton did, and with that small thud, the universal law of gravitation was born. What goes up must come down is true, not only for apples, it's true for the financial markets. Because remember, an asset can only move in three directions. It can be trending up, it can be trending down, or it can be sideways. So knowing when a market is moving up or be able to predict when it's going to start moving down after it's moving up is a very valuable tool. So there are many chart oscillators that try to identify when price turning points that investors like us or traders can exploit. Now, remember, we're talking about technical analysis. Now, a lot of us mix up, not a lot of people mix up, or they assume technical analysis is only about oscillators and indicators. But technical analysis, the entire field of study of any or science on price analysis, is done on a chart. So whether you're doing chart patterns directly on a chart or support and resistance lines, or you're putting indicators and oscillators below, this is all technical analysis. But one sector of technical analysis is called technical indicators. Most indicators are put below the chart, and a group of these indicators that move up and down are called oscillators. And they're also referred to as what we call bounded oscillators because they always come out between a specific number. So for instance, stochastics will always come out between 0 and 100. Okay. And that range is important. Okay. So one of the most regularly followed trend indicators is the stochastics oscillator. It measures the distance between an asset's closing price and the range of highs and lows over a specific time period. As the asset closes nearer to the high of the range, the stochastics oscillator rises. And as the stock closes nearer the lower of the range, it falls. So what stochastics looks at is how high or how low an asset has been trading over a period of time and where it's falling in this range. So proponents tend to like the stochastics oscillator because it's easy to remember defined range of 0 to 100. Its support and resistance indications and its ability to signal divergence in share movement. According to its developer, Dr. George Lane, the stochastics oscillator moves into overbought and oversold areas above 80 and below 20. So on the whole, all that you have to pay attention to is when stochastics falls below 20 or rises over 80. So you could think of between 20 and 80 as a dead man's range, but you can't ignore it either. So Dr. Lane developed the stochastics oscillator in the 1950s. Now, a lot of people have asked me over the years, well, this was before we had Forex, before we had CFDs, before we had online trading. So is it still valid? Well, the fact is that the reason it's still so popular in the marketplace is because it works with every kind of trading now. It works with very fast trading, and it works great for retail investors like you and I. Now, Dr. Lane was quoted as saying, if you visualize a rocket going up in the air, before it can turn down, it must slow down. And the stochastics indicator will tell us when that rocket is slowing down, so we know that it's about to tip over. Now, I'm going to take you over a chart, and putting stochastics on your chart is a very simple thing. Now, as with most oscillators, you'll need to know the directional trend of the asset, whether it's rising or falling. And you'll need to determine that trend over a set period of time. For example, 20-period simple moving average. It may help to look at your assets in a table to see the direction and the position. We don't necessarily need to do this, but let's go over to our chart and put this first on our chart. So I've already dropped it on the chart, and all you have to do is go up here to indicators, locate stochastics, and it will put the standard stochastics on your chart based on the standards developed by Dr. George Lane. Now, of course, you can always adjust these. Okay. Now, it used to be that you couldn't, but today, because we have all these advanced computerized charts, they allow us to customize these indicators, okay, by changing your input levels. Because stochastics is based on a 3-period smoothing moving average, a 3-period D line, and a 14-period K line. And we'll talk about these D lines and K lines, so the red and blue lines you see below. Okay. Now, the fact is, there's all kinds of gurus in the marketplace that'll tell you to use a 15-3 and a 2. Well, they're trying to teach you their strategy, or they're trying to suck you in and say, well, if you do this, and do that, you get a much better range. And when this happens, just buy or sell. Fact is, the 14-3 and 3 was developed by Dr. Lane a lot of years ago, 50, 60, almost 70 years ago. It's been tested through time. It's been back tested, forward tested, traded by millions of people and millions of trades, and it works. If you want to customize it, don't follow some guru. If you want to see a little bit slower, you want to define the signal letter, you make your own adjustment, but then you have to back test and back test and back test and back test to make sure that you have it right. Now, because stochastics isn't complicated, but understanding the K and the D line, which are these red and blue lines on the chart, is a little bit mathematical. I've put together a handout for you. You can see it on your screen right now. It's a Stochastic Guide handout final. You need to click on and download that now because it's not available at any other time. I've also included for you tonight from investing.com an introduction to technical analysis. So that ebook on technical analysis is quite extensive and covers all technical analysis. And the handout on stochastics delves into understanding the stochastics specifically and much better, and gives you charts and examples so that you can follow along, because in this 35, 40-minute class, it's hard to give you everything for everybody at one time and for you to remember it. So we have it right there for you in that guide. So make sure you click on the download buttons and download them now. So like I said, as you can see, putting the stochastics on the chart isn't difficult. Now, you've seen it on the chart, this purple area, and this is just my settings. This purple area, okay, is between the 80 and the 20. Now, some people use a 75 and a 25. Some people use a 70 and 30. This isn't changing the indicator. This is just telling you what you think is important. I stick with 80 and 20 because I want the least amount of signal and the more reliable. Okay, so I would like to get less trading information, but when I get it, have it very, very reliable. Okay, but you can adjust that comfortably. It's not like changing any calculations. It's just changing how you're interpreting when the market is overbought and oversold. So let's go back and let me explain to you how these K and these D lines are calculated. And then we'll go a little bit forward and then talk about how to use them in your trading. Sorry, just having a, there we go. Okay, so let's focus on one of the 3 variations, okay, of the stochastic. So you notice the 2 lines on the bottom. You have, in this case, the black K line, and you have the yellow, and you have the red D line. So the fast moving line is shown as a %K, and the slow moving line is the %D. A slow stochastics. Now, in order to understand the difference in slow and fast, the longer the period, the slower the reaction is. So The slow stochastics would be the larger period, where the short stochastics would be the faster period. So a slow stochastic smooths the percent K line using a default of 3-period simple moving average. The percent D then reflects a moving average of the percent K. So the percent K is, in this case, a 3-period moving average, and the percent D is a moving average of the percent K. And when the percent K crosses above the percent D, giving an indication of support. Okay. So what we're looking at is for the two different lines, the faster and the slower stochastics, to cross each other. So whether it's apples or stocks, gravity pulls them back towards Earth and back to their averages. Sir Isaac Newton found the big moment by a happy accident. But charting with tools, including stochastics, can mean you won't have to wait for the apple to drop. But they can try to pinpoint when it might wiggle. The Stochastics Oscillator is a momentum indicator comparing the closing price of a security to the range of its, or the average of its price over a certain period. The sensitivity of the oscillator to the market movement is reducible by adjusting the time period or taking a moving average of the result. The general theory serving as the foundation for this indicator is that a market trending upward, price will stay near its high. When a market is moving downward, price will stay near its low. Okay, so when price closes near its high, okay, that's its range, and it should stay closer to that high. When the market's moving down, it should stay closer to the low. And we can calculate that by taking each low compared to its moving average, to the overall moving average. And when the moving average is here and the low is lower than that for each day, it gives us a mathematical equation that we can chart. So let me pop up a presentation that'll show you how to do this and will help you along. Okay, so that gave you some general instinct of how to see stochastics on your chart. Now, here we talked about using an 833, modifying the 1433. So let's talk about the formula, okay? And then we'll never talk about it again. But there are two lines for the MACD, and I mean, it's the stochastics indicator. And the first is called a percent K. Now, as you know, all technical indicators only have a basic set of price data that they can use. They use the open, the high, the low, the close, or volume. But that's it. That every indicator is all based on those pieces of data. Now, how they use that data and how they recalculate it or massage it is different. And stochastics does it in a very interesting way. So the percent K line, okay, or the main line, if we want to call it, is simply 100 times the most recent closing price for the, we're looking at a chart now, it's the most recent close of that. So we're looking at 1 hour chart, it's the close of that last 1 hour, minus the low of the 14 previous trading sessions, okay, divided by the high of the 14 previous trading sessions, minus the low of the previous 14 trading sessions. So that's for a 1433. If we're using an 833, instead of using the 14 previous sessions, we're using the 8 previous sessions and the high from the 8 previous sessions and the low from the 8 previous sessions. And this will give us, that little formula will give us the percent K. Then the percent D comes from a 3-period moving average, a simple moving average of that calculation for the percent K line. So if we're using a 433, we have our 14 period and our 3-period moving average. And this gives us our calculations to give us our two lines. Whenever we modify it, we simply change it to the K line is equal to 100 times C minus, in our little presentation, L8. And L8 would be the low of the 8 previous trading sessions. Then we divide it by the high of the 8 previous trading sessions and minus the low of the 8 previous trading sessions. So the general theory serving as the foundation for this indicator is that the market, in a market trending upward, price will stay near the high. In a market trending downward, the price will stay near the low. Now, the transaction signals are created when the percent K crosses through the 3-period moving average called the percent D. So it's really a variation of a moving average crossover. It's just, instead of calculating a moving average, we're calculating this unique mathematical formula of using these opens, highs, lows, and closes in a unique combination. So the K line is the fastest and the D line is the slower of the two lines. The investor needs to watch as the D line and the price of the issue begins to change and move into either the overbought or the oversold situation. Above 80 is telling you it's overbought. When the market is overbought, it means the price has gone too high and it's weighted down. The rocket's moving up and it's starting to lose momentum. But it doesn't tell you when that actual rocket's going to fall back down. Okay, because it can still move up and up and up and up, but at a slower pace, because we know it's eventually you're getting prepared to fall downward. So when your stochastic is at a high value, it means the price closed near the top of the trading range. So that's what I'm saying. When stochastic gets higher and higher above the 80 line, is telling you that the market is trading at the top of its trading range. When it's trading below 20, it's trading near the bottom or the lowest of its trading range. So the main difference between the fast and slow stochastic is summed up in the word sensitivity. The fast stochastic is more sensitive than the slow stochastics. So there are three versions of the stochastics oscillator. The fast stochastics oscillator is based on George Lane's original formula, the percent %K and the percent %D. The percent %K is the faster version that appears rather choppy, and the percent %D is the 3-day moving average of that. In fact, Lane used a percent %D to generate buy and sell signals based on bullish and bearish divergence. So let me try to explain this to you in an easy. So now, as with any other trading concept or tool, you should not use stochastics indicator by itself. To receive meaningful signals and improve the quality of your trades, you can combine stochastics indicators with these three tools. And as you saw in the presentation, moving averages. Moving averages can be a great addition here as they act as a filter for your signals. Always trade in the direction of your moving average, and as long as price is above the moving average, only look for longs or if price is below the moving average, look for sells or shorts. Price formations. A breakout or a reversal trader should look for wedges, triangles, and rectangles. When price breaks such a formation with an accelerating stochastics, it can be a potential signal of a successful breakout. Then with trend lines, especially stochastics divergence or stochastics reversals, can be traded nicely with trend lines. You need to find an established trend with a valid trend line and then wait for price to break it, and with the stochastics confirmation or confirming your trade and to enter that position. So as you see on this chart, we see a very well formed uptrend. We see price break the trend lines and stochastics moves to a new low, and that's signaling that uptrend is over, and we would look for a short entry position. So you might not need the stochastics indicator when you are able to read the momentum of your charts by looking at the candles. But if the stochastics is the tool of your choice, it certainly does not hurt to have it on your charts. More importantly, is meant to realize how little you might know about the tools you use for your trading. Additionally, there is a lot of wrong knowledge being shared among traders, and even widely used tools such as stochastics are often misinterpreted. Most traders mix up overbought and oversold indicators as buy and sell. They don't understand that overbought means a price can still continue moving up. It's not telling you the price is falling or going to fall now. It's just telling you the price is getting too heavy and that rocket's going to eventually or starting to turn back to earth. So do not blindly believe what other people tell you. Do your own research and build your own trading knowledge. Now, traders will often cite when a stock makes higher highs, but the stochastics does not exceed its previous swing high, that the trend is in jeopardy. This couldn't be furthest from the truth. The slow stochastic indicator ranges from 0 to 100. So as the stock rallies, you can see the stochastics continue making higher highs. If it hits 85, 98, and 85, unlike price, which has no boundaries, the slow stochastic is an oscillator, so it will never truly mimic a securities price action. All that matters is that the stochastics continues in the direction of the primary trend. Traders will often exit long trades when the slow stochastics crosses over 80, or will buy when the slow stochastics crosses below 20. The problem with this trading methodology is that as assets price over 80, it should not be looked at upon overbought, rather as trending strongly, or as I said, starting to lose its momentum. Also, same as reverse under 20. Now, there are many different strategies that you can use to trade stochastics, okay? And you have to learn all of them, but identify stochastics with smooth slopes, okay? You can look for weak, slow stochastics as buy signals. Follow the sloppy stochastics. And each one of these are little methods that they're explained to you in that handout. So there's all types of variations of what you can do. But the simple answer is that you can take a position in the direction of the primary trend. So remember, trading is not simple. Now, I do not want to leave you with the impression that you can simply buy or sell a stock when it's hitting the trend line and above or below 20 or 80. Trading is not that simple. You can, however, utilize the slow stochastics to validate the health of a trend relative to previous peaks by seeing if the asset is able to make higher or lower slow stochastics readings. The way you can size up a recent high relative to its predecessors to determine if it really is time to sell or if the stock has got more room to go. Regardless, if a trend line is staring you in the face, don't ignore it. So while momentum oscillators are best suited for trading ranges, they can also be used with securities that trend, provided the trend takes on a zigzag format. Pullbacks are part of an uptrend that zig higher. Bounces are part of a downtrend that zig lower. In this regard, the stochastics oscillator can be used to identify opportunities in harmony with a bigger trend. The indicator can be used to identify turns near support or resistance. Should a security trade near support with an oversold stochastics oscillator, look for a break above 20 to signal an upturn or a successful support test. Conversely, if it's over 80. The settings for stochastics depends on personal preference, trading style, and time frame. But remember, the 1433 is what it was developed as, and that's the true value. You can modify it as we showed you in the presentation, but a shorter look back period will produce a choppier oscillator with many more overbought and oversold readings. A longer look back period will provide a smoother oscillator with fewer overbought and oversold reasons. So like any or all technical indicators, it's important to use the stochastic in conjunction with other technical analysis tools. Volume, support and resistance, and breakouts can be used to confirm or refute signals produced by the stochastics oscillator. So hopefully, we've given you some general aspects. The handout I gave you on stochastic is more precise, and our introduction to technical analysis will help you along. But if you want more advanced training, more support, go to www.legacyfx.com, go to their education section, and you'll be able to find all the information you need in video format, ebook format, and all types of presentations to help you better understand this trading oscillator. So thank you very much for joining us tonight. Have a good night now, and thank you for supporting both investing.com and Legacy FX. Good night now.